Hey guys, Tish here from Black Sheep Finance. Today I'm going to be talking about how you can pay your home loan off faster. Because you may have just got a home loan recently, maybe you've had one for a while, but having a debt for 30 years can seem quite daunting. And obviously, how are you ever going to get ahead? A lot of the times, retirement is set not based on age, but finance. All through our lives, we're working hard, really slogging away to pay off our debts. And really, financial freedom comes down to when you are free from finances. And unfortunately, a mortgage, even though we love the houses that we live in and the Australian dream is to own an amazing house, often the vehicle that gets us to that dream house is a mortgage, and that really ties us down and prevents us from living the life we really want because we're too busy paying a debt, basically. So it's important sorry, I just got a phone call, interrupted me. This is the trouble with making feeds during the day. People call me. Where was I? So we want to pay off our mortgage faster, and it's going to basically free up us to retire earlier. So we want to pay this thing off as fast as possible. The key really is not to overstretch yourself. So when you go and find out what your borrowing capacity is, let's say, you're a couple and your borrowing capacity is 500,000. That doesn't mean you should spend 500,000. If you borrow the absolute maximum that the bank says you can borrow, you are at your capacity, which means you're really going to struggle to meet your repayments. So you always want to go below where your actual borrowing capacity is, which means you can have more lifestyle and obviously achieve your goals a lot faster. So tip 1 to paying your home loan off a lot faster is schedule the repayments to coincide with your payday. Now, you're probably already doing this. It's really simple. But whenever you get paid, whether it's weekly, fortnightly, whatever, you should coincide your payment to be 2 days after that. Because people always spend what they earn. So if you wait until the end of the week to see what you have left over to chuck in, it's not really going to work. You've got to make a decision up front as to what repayments you're going to be making and actually set it, like direct debit. Like, you have to do this like forced. So plan ahead exactly how much you're going to put away over and above your minimum repayment, and set it in line with your pay date so you can't go and spend that excess money. So really simple. Schedule your repayments and direct debit. Always direct debit. So tip 2 is really simple. It's changing the repayment frequency. So a lot of people don't understand that there are more than 4 weeks in a month. So whenever I ask people, because they ask, what are my repayments? I'm like, well, would you like it weekly, fortnightly, or monthly? Because if I tell them the monthly amount, in their head, they divide it by 4 to get the weekly amount, which is incorrect. Because technically there's 4.3333 reoccurring weeks in a month. So you have to understand the calculation correctly. So there's 52 weeks in a year, 12 months, right? So 12 times 2 is 24. So if you're making half monthly payments, you're making 24 payments. If you pay fortnightly, how many fortnights in a year? 26. Spooky, I know. So if you pay fortnightly, that's 26 versus 24. Technically, you're getting an extra month payment in every single year. So fortnightly is beneficial. I myself get paid monthly. So even though it's easier to have my repayment come out monthly, it's not as beneficial if I do it fortnightly. So here's an example. If you've got a $350,000 mortgage, assuming an interest rate of 6%, and you pay fortnightly, so all you're doing is changing the repayment, you will save 5 years and 6 months, or $86,842.24 in interest. Like, that's a lot of money and a lot of savings just because you changed the frequency. Really simple. Step 3, lump sum payments. So you might not win the lottery, but throughout our lives, whether it's in the next 10 years, 20 years, 30 years, you'll probably come into some money of some sort. It could be through an inheritance or an insurance claim, or more commonly, tax returns. A lot of people go out and spend their tax returns, but you should be budgeting for holidays anyway. You shouldn't be going, when I get my tax return, I'll go on a holiday. When I get the tax return, I'll buy a TV. You should be planning for those purchases anyway. Therefore, when you get lump sums, they should be going off your debts. Yes, it's easy to just fall onto your laurels and go, it's a really massive debt, I'll just pay it off eventually. If you want to pay this thing off, the sooner you can pay your mortgage off, the sooner you can retire. Because once you've got rid of that massive debt, you've got all this extra cash flow that can go towards funding your retirement. So the longer you take to pay this thing off, the longer you have to work for. No one wants to work for 40 years. I'm ready to retire now, okay? So you need to start taking actions. So if you, let's say for example, like let's look in small, okay? So you got your tax return, let's say $2,000. Even if you haven't got a tax return, if you can come up with a lump sum of $2,000 every year, just $2,000 just once a year, and you put that lump sum into your mortgage, you'll save 5 years and 3 months, or almost $86,000, just by putting your tax return away, or coming up with another lump sum. Number 4. Make extra repayments. So it seems really, really basic. I guess a lot of people know that you should be making extra repayments. But again, it's about consistency. It's always about consistency. So committing to go, okay, well, you know, the bank says we can afford this much. So if you actually do the calculation, go, oh, our repayment's only $2,000, but $2,000 a month. But the bank thinks we can afford 2.5. Put the 2.5 in. Make that commitment. If you've got the capacity, as soon as you lock it away, it will just become the norm. When I got one of my mortgages 7 years ago, interest rates were like 9%. So my repayments were quite high. When it came out of that, I think my interest rate dropped down to about 5 or 6%. Keep paying what you were paying. You've already adjusted your lifestyle. I adjusted my lifestyle for 5 years making that commitment. If you then go back to whatever the minimum is, you're not getting ahead. And similarly, what a lot of people don't do is they keep making the same repayment consistently throughout the years, but your pay goes up. If your pay is going up, why aren't you also adjusting your commitments? If you really want to get ahead, each time you get a pay increase, you should be contributing a portion of that and increasing your mortgage repayments as well. So if you make extra repayments, so I recorded a video the other day, 21 days to boost your home deposit. These same principles can apply to getting extra cash to pay your home loan off quicker. So let's say you only pay an extra $100 off a week. That's easily done if you borrow within your capacity, and you can easily find $100 extra per week. You'll have it paid off in 20 years, less than 20 years, and save almost $160,000 in interest. It's just $100 a week. Anyone can come up with that. Really, really simple. Last step, so offset accounts. I'll do a separate video about offset accounts because offset accounts are sexy. They are awesome. Offset account is basically, it's a transaction account. So it's savings account, has full capacity and transactability. So you can link credit cards to it, debit cards, take money out at the ATM. It's a normal account, but it's linked to your home loan, which means every single dollar that's in that account offsets, hence the word offset, the mortgage. So for example, you've got just easy maths, you've got a $350,000 mortgage, you've got $50,000 in your offset, you only pay interest on the $300,000. So like every single dollar counts, which is why you should always have your pay going into this account, because interest is calculated daily. It's charged, whatever, weekly, fortnightly, monthly, but it's calculated daily. So the more money you have running through this account, the better. So if you've got different sources of income, which is why I'll do a separate video on it, because if you've got rental income, if you've got, there's 2 of you, so instead of having separate accounts, you should have everything churning through that offset, because the more money in there, the more savings you get. It's unfortunately the calculators out there aren't smart enough to come up with variable solutions, but let's just say hypothetically you've had $20,000 sitting in that account. So assuming it's in there for the whole year, you'll save $106,000. And that's just by having it in that account instead of a normal savings account. So why would you not want to save $106,000 just by changing the account? It's crazy. So, if you've only got, so if you don't have any, a massive amount of money, but if you have your salary running through this and you've got a little bit of savings and you maintain a balance of $2,000 per month, then you'll save almost 12 grand in interest. So it's all these little things that add up. It's just about committing to exactly where you want to go, and every time something happens is making an adjustment, because you want to have this paid off no more than 20 years. 20 years is too long for a mortgage. Obviously, you start off at 30 years. You make the repayment as minimal as possible, so if things go wrong, you can rest back on that minimum. But you need to book everything in, do the calculations, and go, okay. And then once you've actually paid it off, oh my God, I see so many people in their 50s who have like tiny mortgages and they make tiny repayments. Like the big spenders are baby boomers. Like, my dad's probably going to watch this, and Dad, you are so guilty of this, because once you got your home loan paid off, you've got all this extra cash, and it's too easy to slip into this lifestyle where you just start spending. But you have to retire soon. So as soon as you've paid a debt off, same thing applies if you've got credit cards, personal loans. You are making a commitment. You've already got that in your budget. As soon as a credit card goes, as soon as a personal loan goes, and as soon as a home loan goes, you don't just go, oh, cool, I've got an extra $100 a week, I've got an extra $350 a month or whatever. You take that payment and you put it somewhere else. It's called the snowball debt reducer. It's actually a thing. You can Google it if you want. So once one thing's paid off, you take that same repayment and you put it into something else. That's how you can reduce debt really, really quickly. It's like a snowball effect. So once you've got all your debts paid off, including your home loan, you'll have thousands of dollars that you can put away, and all of a sudden retirement's looking a lot sweeter because you've got all this cash coming in that you've already committed into your existing budget that you can put away to have a much, much better retirement. So even though it may seem like, oh, retirement's ages away, it's further away if you don't plan for it. And the biggest thing that's stopping you from retiring is your mortgage. So a lot of you out there haven't even got a mortgage yet and are just starting to look into it. But once you get it, it's a massive commitment, and you have to plan for it and pay it off as soon as you can, basically, so you can retire faster and actually enjoy life. So hopefully that's been helpful, guys. I'll speak about offsets in more detail and how you can really maximize that tomorrow. Have a great day. See ya.